In a move that sent shockwaves through the auto industry and local communities alike, Toyota abruptly canceled its highly anticipated $9 billion Project 50 EV and battery plant in Huntsville, Alabama. The decision came seemingly out of nowhere, blindsiding state officials, workers, and business leaders who had spent months preparing for what was promised to be a transformative investment in the region. For many, this project represented not just a factory, but a beacon of hope for thousands of families, and a new era of economic growth in the American South. The project, once hailed as a generational opportunity for Alabama, was scrapped before construction even began, leaving the community reeling from the sudden loss. Local leaders scrambled to understand what went wrong, while workers who had pinned their hopes on new jobs faced an uncertain future. The ripple effects were immediate, with small businesses and suppliers bracing for the economic fallout. Instead of Alabama, Toyota announced that the entire investment would shift north to Windsor, Essex, Ontario, Canada. Practically overnight, this decision transformed the Canadian region into a new epicenter for electric vehicle manufacturing. The announcement was met with excitement and optimism, as Windsor, Essex prepared to welcome thousands of new jobs, fresh infrastructure, and a surge of global attention. The contrast between the two regions was stark and emotional. Alabama faced economic loss, disappointment, and uncertainty, while Ontario celebrated a historic win that promised prosperity and growth for years to come. The shift left many in Alabama questioning the future of manufacturing in their state. But this wasn't just a simple change of address. Toyota's move sent a clear message to the world. Global companies are now prioritizing political stability, reliable trade relationships, and long-term security over traditional incentives like tax breaks or cheap land. The decision reflected a new era in international business strategy, where certainty and trust matter more than ever. The story of Toyota's dramatic move is more than just a tale of two factories. It's a powerful illustration of how unseen global forces, from shifting trade policies to geopolitical tensions, can dictate the fate of entire communities. In today's interconnected world, the destinies of workers and capital are shaped by decisions made far beyond their borders, reminding us that the global economy is as unpredictable as it is interconnected. Toyota's reversal was driven by mounting concerns over U.S. political and economic instability. An internal risk assessment flagged the U.S. as high risk for long-term investment, citing volatile policies and threats to trade agreements like the USMCA. For Toyota, the risk of sudden tariffs or regulatory changes made Alabama untenable for a decades-long commitment. The company feared its Alabama-built EVs could face punitive tariffs, disrupting its North American business model. Stability and predictability became non-negotiable, outweighing Alabama's tax breaks and workforce. Toyota's methodical, risk-averse culture simply couldn't accept the chaos of the U.S. climate in 2026. Alabama lost not by its own fault but because national uncertainty turned a $9 billion investment into a gamble. While the U.S. wavered, Canada launched a quiet, targeted diplomatic campaign led by Mark Carney. Instead of public bidding, Canada offered Toyota a unique sovereignty shield, a government guarantee to cover any U.S. tariffs on Canadian-made Toyotas until trade disputes were resolved. This bold move erased Toyota's biggest financial risk. Canada also highlighted its vast critical mineral reserves, abundant clean energy, and global trade access, making Windsor a strategic EV hub. The pitch built in Canada for duty-free access to the US, Europe, and Japan, all with government-backed stability. Canada's offer wasn't just a location, it was a comprehensive solution to Toyota's fears. In the end, Canada's blend of diplomacy, resources, and guarantees proved irresistible. The loss of Project 50 devastated Huntsville. Thousands of direct jobs and billions in investment vanished overnight. The ripple effect hit local suppliers, logistics, and small businesses, erasing a generation's economic hopes. Meanwhile, Windsor, Ontario, celebrated a transformative victory. The new plant promised thousands of jobs and a revitalized manufacturing base, positioning Windsor as a North American EV powerhouse. Ontario's supply chain, tech firms, and service industries braced for a surge in growth. For Windsor, it was a turning point. For Alabama, a painful lesson in the high stakes of global investment. Two communities, two futures, shaped by a single corporate decision. Financial markets responded instantly. Toyota's stock soared 4% on the news, adding billions in value. Investors saw the move as a smart bet on stability, rewarding Toyota for prioritizing predictable operations and tariff-free trade. Meanwhile, shares of GM and Ford dipped as Wall Street interpreted Toyota's exit as a warning about U.S. instability. Canada was quickly seen as the new safe haven for auto investment, attracting capital and attention. The market's message was clear. In a world of uncertainty, stability is king. For decades, the U.S. was the gold standard for investment. Toyota's move shattered that assumption. The episode was a wake-up call. Political volatility has real financial consequences. With Toyota's sudden departure, the U.S. found itself at a crossroads, facing a dilemma that would test the resolve of its leaders and the resilience of its economy. Should America strike back with force, attempt to negotiate a truce, or simply accept the loss and move forward? Each path carried its own set of consequences, and none offered an easy way out. The most immediate and likely response on the table was to impose heavy tariffs on Canadian imports. Such a move would send a clear message, but it also risked igniting a full-blown trade war, one that could cripple the North American auto industry, disrupt supply chains, and send shockwaves through the global economy. Alternatively, the U.S. could try to lure Toyota back with even bigger incentives, tax breaks, subsidies, or regulatory concessions. But industry experts were skeptical. Toyota's decision was about more than just money. It was about trust, reputation, and long-term strategy. Reversing course now could damage the company's global standing and set a dangerous precedent. The real danger, however, was that Toyota's bold move might inspire other global manufacturers to follow suit. If one giant could leave, what was stopping others? The result could be a domino effect, a wave of capital flight and factory closures that would hollow out America's manufacturing base and threaten millions of jobs. Each option on the table carried enormous risks. A trade war could spiral out of control, failed negotiations might embolden competitors, and a manufacturing exodus could devastate entire communities. The stakes were not just economic, they were political, social, and deeply personal for workers and families across the country. The U.S. government now found itself in a bind, with every move scrutinized by boardrooms and investors around the world. The pressure was mounting, and the margin for error was razor-thin. One wrong step could escalate the economic damage, trigger panic in financial markets, or send a signal that America was no longer the premier destination for global investment. The world was watching, and confidence in the U.S. economy hung in the balance. In this high-stakes game of retaliation, the future of American industry and its place in the world was on the line. The stakes have never been higher. For American consumers, the fallout is simple: higher car prices and fewer choices. If the U.S. slaps tariffs on Canadian-made vehicles, the cost will hit buyers, turning a $40,000 EV into a $48,000 purchase overnight. Tariffs would also disrupt the entire North American auto supply chain, raising prices on Fords, GMs, and more. Shortages and delays would become common, as cross-border production grinds to a halt. The result? A lose-lose for car buyers, higher prices, less selection, and a stalled EV transition. The intricate web that kept cars affordable is unraveling, not from lack of technology, but from policy choices. In the end, it's consumers who pay the price for geopolitical drama. Toyota's move is a defining moment for North America, a lesson in the new priorities of global capital. The decision to shift production is more than a business headline. It's a signal that the rules of the game are changing for everyone, from factory workers to policymakers. In a world where uncertainty is the new normal, companies are rethinking what matters most. Political stability and rule of law now outweigh tax breaks or cheap labor. Investors are looking for environments where they can plan for the long term, not just chase short-term gains. Governments that offer predictability and a sense of security are becoming the new magnets for global investment. For Alabama workers, the loss was out of their hands. National politics, not local effort, cost them their future. Despite years of dedication and hard work, the fate of their jobs was decided in boardrooms and government offices far away. It's a stark reminder that local communities are often at the mercy of global forces beyond their control. For consumers, the fragility of global supply chains is now painfully clear. Delays, shortages, and rising prices have become part of daily life, revealing just how interconnected and vulnerable the system really is. The ripple effects reach far beyond the factory floor, touching families and businesses everywhere. Canada's win was no accident. It was the result of long-term strategy, stable policy, and smart diplomacy. By building trust and offering a reliable environment, Canada positioned itself as a safe harbor in turbulent times. This success story is a blueprint for how nations can attract and retain investment in an unpredictable world. The US learned a costly lesson: market size alone no longer guarantees investment. In today's climate, even the biggest players must adapt to new realities. It's a wake-up call for American industry and government alike. To stay competitive, they must offer more than just scale. The future of the auto industry now hinges on Washington's next moves: de-escalate and rebuild trust, or double down and risk further losses. The choices made in the coming months will shape not just the industry, but the economic landscape for years to come. The fate of jobs, prices, and entire communities hangs in the balance. As the world shifts, the lessons learned here will echo far beyond North America, reminding us all that in a global economy, every decision has consequences.